call is open for investors in Ellerston Asian Investments. If you're a member of the media, you should disconnect now and request a formal interview by contacting us. All information contained herein is confidential and must not be reproduced without the consent of Ellerston Asian Investments. You should also be aware that any information is general and does not take into account your personal objectives, financial situation, or needs. Well, good morning, everyone, and thank you for joining the Ellerston Asian Investments webinar. My name is Lisa Rose, and I'm the Head of Intermediary Sales at Ellerston Capital. Today, we're again joined by Ellerston Asian Investment Team, led by Portfolio Manager Dr. Mary Manning, and including Freddie Ho, Eric Fong, and Vinay Choda. In today's presentation, Mary and the team will provide an update on performance for November, detail portfolio positioning, and discuss the team's outlook for Asian markets in 2021. As usual, I'm sure you will have many questions, and we'll seek to answer as many of these as we can throughout. If you'd like to ask Mary and the team a question throughout the session, you can submit this at any time. Please do so by entering your inquiry into the question section of your webinar panel located on the right-hand side of your screen. I'll now hand over to Mary to start the presentation.
Thank you very much, Lisa, and thank you to all the investors who have dialed in. It's nice to speak with you again. So today we have a presentation on what's happened in Asia in 2020 and also our outlook for 2021. So first of all, thank you all for your participation over the last few months in these webinars. It's been a really good experience. If we look on slide 2, I'll just briefly talk about performance in the last month, and then we'll go on to some other items. So Ellerston Asia was basically flat during November. The benchmark was up 2.91%. So we did underperform on a 1-month basis, and the reasons for that are a lot of volatility in the market with respect to the U.S. election, the cancellation of the Ant IPO, certain news in terms of China internet regulation, and lastly, sector and factor rotation. But we'll go over that later on in the presentation. Calendar year to date in 2020, EAA is up 10.6%, and we've outperformed the benchmark by about 100 basis points. And in the last year, we're up 14.5% and have outperformed the benchmark by 2.3%. The most recent NTA is approximately $1.30. So if we move on to the next slide, as you know, we are very focused on making sure that we have a rising and sustainable dividend to be able to pay our shareholders. So the last dividend paid, as you would know, was in October, and the dividend profit reserve as of the end of November was 12.05 cents. So you can do the math in terms of what that implies in terms of our sustainability to be able to continue to pay a dividend. But we are very conscious of the fact that a dividend is one of the reasons why investors like our stock, because it gives you the growth on the one hand with respect to access to Asian growth, but it also pays a dividend. So we are very focused on that, and 12.5% is a decent dividend profit reserve. Moving on to the next slide. I'm just going to talk a little bit about the November market movements and how this impacted our performance versus the benchmark. So if you look at overall market movements in November globally, markets didn't go up or down that much, but underneath that, it was very, very volatile. So there were a number of things that were causing this volatility. If you watch or read a lot of the news commentary, it was all about market rotation. But what does that rotation actually mean? A lot of people think it means rotation from growth to value, but we actually did a lot of analysis, and there were multiple different kinds of rotation that were going on. So we can just go through a number of these. I guess the first rotation that happened during the month was because of the U.S. election. This was not specific to Asia. This was, happened more for global funds, but it sort of set the month off on a rotational trajectory. So going into the U.S. election, as you may recall, if you had dialed into some of our other webinars, there was a lot of different scenarios, and one was a blue sweep scenario, which was, I think, most investors' base case. But when it became clear, even before we knew the results of the presidential election, that it was not going to be a blue sweep and it would most likely be divided, you saw straight away NASDAQ futures start to rally quite aggressively because a lot of people were underweight or short tech because they thought that a Biden administration would go after big tech and repeal some of the regulation Trump had put in place, which was beneficial for big tech. So straight away you had some global funds reorganizing their portfolio right on November 4th or November 5th our time. Then the second thing that happened was, even before we knew the ultimate results of the U.S. election, the vaccine news results came out from Pfizer BioNTech. And so this was actually the most violent day of factor rotation ever since people have been tracking it. So for many months, people have been positioned in stay-at-home plays for obvious reasons. And stay-at-home plays are often related to technology, and they're more growthy stocks. and people have been positioned that way for many years. And when the vaccine results came out, that just flipped on its head, because all of a sudden people are thinking, I don't want to be at stay-at-home plays anymore. I want to be in reopening plays. And so you saw a very, very big shift on, I think that was November 9th, the day that happened. So even like in the first 2 weeks of November, you'd already had two sort of rotations. With respect to vaccine results, it wasn't just stock and sector rotation, it was also country rotation for funds that invest in multiple countries. So for us, as you will know, we have been primarily invested and focused on North Asia because North Asia has done a much better job of getting COVID under control. But once a vaccine comes out, obviously that turns that on its head also, and that countries that have been more affected by COVID will be bigger beneficiaries of the vaccine. Overall, rotation from growth to value has occurred, and part of that is because the differential between growth performance stocks and value stocks, that performance differential is getting very wide. And also people look back at the Trump bump and recognize that in a new administration there are often reflationary tendencies, and that certainly in Trump's case did lead to a rotation out of growth and into value. More closer to home for us, there was some rotation within Chinese internet stocks. So Eric will talk about this a little bit later, but there has been, in the wake of the Ant IPO cancellation, or maybe just as a separate event, there has been some antitrust regulation drafts come out in China. So this has meant that there is potentially more risk to the mega cap stocks like Alibaba and Tencent, whereas there could be potentially positive outcomes for some of the non-ecosystem challengers, we call them, like PDD or Meituan. So there's a little bit of intersector rotation there. One thing that Freddie will talk about later on is the weak US dollar and the implications for commodity prices. One of the sort of defining characteristics of Biden's tenure so far, or President-elect's tenure so far, is that the US dollar has been very weak. This is generally good for commodity prices, but because of our strong ESG credentials, we generally don't own a lot of commodity companies, so that is a sort of net negative for our positioning. And then all of the above have sort of meant that there's been rotation from leaders into laggards. That's just a few comments on rotation in November, and that's part of the reason why we underperformed during the month. So what did we do to change positioning because of this? A few things. The first is we've added a lot of financials. So if you remember from last month, there was about 22% of the portfolio was in financials. Now it's up around 30. And so that was, to add 800 basis points in a short period of time is quite significant. The reason we did this is because financials, the financials that we invest in, because they're in high growth countries, they are growth stocks, but financials as a whole are generally low PE. So I think the average of the banks that we own is probably around 10 or 11 times PE versus the average of our tech portfolio is probably double that. And so adding financials helps when there's a rotation from growth to value. The second thing is that the yield curve is steepening in the US. It's not very steep, and certainly the absolute level of the US 10-year is not very high, but this is a good time to be in financials. And the third thing that happened is that the reason why we were underweight financials before and actually had a preference for insurance over banks is because the NPL cycle due to COVID, it was sort of unclear what that would look like. But banks globally actually reported quite good second quarter and third quarter numbers on the NPL front, so we feel much more comfortable with asset quality. We have added some ASEAN. That's to the point I made earlier about markets that have not done a good job of controlling COVID will be better off with a vaccine. Previously, we had no exposure to ASEAN outside of Singapore. We have added stocks in Indonesia and the Philippines and Thailand in the last month. Alibaba and Tencent, as I mentioned before, we have a preference now, or we want to make sure that we manage that sort of mini portfolio properly. So we have significantly reduced our Alibaba position, which a few months ago was over 14%, and now it's under 8%. We've significantly reduced Alibaba, and we've kept PDD and JD and Meituan, some of the smaller Chinese tech companies. We still have limited exposure to materials because of our strong ESG, but we have added one or two stocks there where we can find companies that meet our ESG criteria. And our overall preference, which Vinay will talk about later, is not to invest heavily in reopening plays, because I think there's a lot of permanent changes that have happened because of COVID, and a lot of analysts and commentators are talking about when things get back to normal, that's what a reopening play is, but I don't think people have a good idea what that new normal is going to be. So our preference is to invest directly in vaccine and healthcare companies that will benefit from a vaccine rather than in reopening plays. That said, we have added a little bit of Budweiser APAC for that reason and for other reasons. So those are the changes to our positioning in the last month and a bit. So if you flip over to slide 6, this shows how we're positioned right now. You can still see that China-Hong Kong is the biggest part of our portfolio at around 48%. We still do have, a lot in North Asia with Korea and Taiwan significant weights, but we have added considerably to ASEAN, and India remains around 11%. Cash is around 6.5%. And then in terms of the sector exposure, financials, technology, and consumer remain our three core sectors, as you can see there. But as I mentioned before, financials is bigger than it was at the end of the last month. So that's just an update on portfolio. We'll move along now to the outlook for Asian markets in 2021. So if you flip to slide 8, you've all seen this slide before. If you've been coming to our webinars regularly, we started off with the first wave, and now we're in the second wave, and you can see the number of countries that are sort of piling up at the end of the second wave is growing. We are watching Europe and the US obviously very closely because with the winter there and a number of other factors means that in some cases even the first wave is not at all under control. So we do think that as a region, Asia continues to do much better than a lot of the developed markets, and this is one of the main reasons why we think investing in Asia and emerging markets for 2021 is a much better asset allocation decision than investing in developed markets. If we flip over to the next slide, these are just some numbers behind what I just mentioned. If you look at what's going to happen to growth, amazingly, China is expected to post positive GDP growth in 2020. So if you think back, almost a year ago now, at the end of January, when COVID first hit, a lot of those, forecasts were saying very, very sharp recession in China because of COVID. But because China did a good job of controlling the epidemic and giving exactly the right, in my opinion, exactly the right amount of fiscal and monetary stimulus, they will have 2% growth this year. Whereas you can see all of the developed markets are sharply negative, and that Asia ex-Japan number is okay, but that's actually pulled up a lot by China. So really, in the global economy right now, China is a standout in terms of macroeconomic strength. If you look at the next column, because we do get pushback on this saying, yeah, well, the number looks great this year, but then the other countries will have a bigger rebound in 2021, but that's certainly not the case. You can see in 2021, China is expected to grow back up at 8.2%, and the rest of the countries, while they do get a sort of mathematical rebound from a low base, that growth is still pretty paltry, and then by 2022, they're back to sort of 1 to 2% GDP growth, while China and the rest of Asia is still up around 5%. So we feel very comfortable from an asset allocation perspective that Asia is where you want to be. And I also think that some of the policy decisions that happened in developed markets over the last few months highlight the fact that there's not a lot of policy optionality in developed markets. So you have most developed markets, including Australia now, that are at zero bound of interest rates, and you've had extensive fiscal stimulus such that debt and deficit levels are potentially unsustainable. So I think that Asia, because growth is already better than in developed markets, and because they have that policy optionality, it's a great place to invest in 2021. So with that, I'm going to turn it over to Vinay, who's going to talk about the implications of a vaccine for Asia. Go ahead, Vinay.
Thanks, Mary. On the vaccine front, we've seen thousands of scientists deployed by multiple pharma and biotech companies working around the clock to develop an effective COVID-19 vaccine since the start of January. In the past few weeks, there have been several announcements, including better than expected efficacy from phase 3 trials of vaccine candidates being developed by Pfizer and Moderna. Both vaccine candidates have demonstrated more than 90% efficacy. It is unprecedented in scientific history, and quite frankly, it's an extraordinary achievement to go from the discovery of a deadly new virus to the creation of a potentially effective vaccine that can block its effects in less than a year. To give you a sense of just how significant this is, the normal vaccine development timeline is usually about 10 years on average. And even then, the probability of developing an effective vaccine is extremely low. But all said and done, the development of an effective vaccine is positive from a public healthcare perspective and from a markets perspective. But there are execution issues, especially ones relating to logistics, distribution, and cold chains that we are concerned about. And this is notwithstanding the fact that the world has never undertaken such a massive immunization drive at a global scale. We remain hopeful, though, but are cautious on the immediate impact for low-income countries with underdeveloped healthcare and logistics infrastructure. We therefore prefer to hold direct vaccine beneficiaries rather than reopening places like airlines and hotels or tourism-related businesses. We don't think the airlines or the travel-related businesses are going to go back to what they were pre-COVID for at least the next few years. Our COVID beneficiaries include Fosun Pharma and Fushi Biologics in China and Dr. Reddy's and Sun Pharma in India. I'd like to now hand it over to Eric, who will talk a bit about the US-China relations.
Thanks, Vinay. So the US-China relationship has been a roller coaster since President Trump took office. And 2020 was an especially difficult year given the election and also the bipartisan negative views on China. We started the year with a positive note when the US and China signed the Phase 1 trade deal, but that was soon overshadowed by the coronavirus outbreak in Wuhan. Following that, we have numerous flashpoints, which we would put into 4 categories here. First is Hong Kong. The key issue here is clearly the implementation of the national security law after the massive protests in 2019. The protests came to a quiet end after the COVID outbreak, and the Chinese government swiftly introduced the law which will criminalize these anti-government activities. In response, the US government removed the special trade status of Hong Kong and also imposed sanctions on Hong Kong and Chinese government officials for violating human rights and democracy in Hong Kong. Second is technology. We've always said that this is not just a trade war, but also a tech war. In our view, this is more about the ascendancy of China, which is threatening the US tech supremacy. We have seen an ongoing crackdown on Chinese tech companies such as Huawei and ZTE, with the US imposing export controls on Chinese tech firms. The crackdown extends beyond the hardware space, with internet apps such as TikTok and WeChat also targeted by the Trump administration. Third, capital markets. The Trump administration has also targeted Chinese companies listed in the US. The passage of the Holding Foreign Companies Accountable Act, which proposed the listing of foreign companies that failed to provide their order paper to the US regulators. Trump also issued an executive order which banned the purchase of certain Chinese securities with military ties to the Chinese government, and this has led to index providers to remove 21 names from the index. We don't have any exposure to those names. And it's important to note that these are even announced after Trump lost the election. And lastly, on trade, yes, we had the Phase 1 trade deal in mid-Jan, but this soon become irrelevant as coronavirus took the center stage. To recall, the US has halved the tariffs on $360 billion worth of Chinese exports in exchange for more Chinese purchase, firmer commitment on IT protection and no ethics of manipulation. But the trade deal itself doesn't touch on the difficult topics such as Huawei, state subsidies, market access, etc. So now we have a new president coming in January. What should we expect? We don't expect the tensions between the two countries to disappear because this anti-China view is bipartisan. However, we do expect a change in approach with Biden. He's expected to be more diplomatic rather than confrontational, more multilateral rather than bilateral, and more human rights focused. There should be more predictability with this new administration, which will be a welcoming news to the stock market. Now, moving on to the next topic, the next slide, which is on internet and antitrust. As many of you would know, we have decent exposures in tech companies, especially China internet, with the likes of Alibaba and Tencent. There is a recent industry development which prompts us to reduce our exposure to the space in Indonesia. In early November, the government issued a draft antitrust guidelines on antitrust activities regarding internet platforms. As these internet platforms become larger and more influential, the government wants to make sure that there is fair competition and smaller players, including the merchants, are not being squeezed out of the market. The whole antitrust movement isn't just a China phenomenon. Elsewhere, we have also seen the US government taking on Facebook and Google, seeking to curb this monopoly power of these internet giants. So after the announcement, we saw these Chinese tech names taking a breather after a strong year, as you can see on the right-hand side of the chart, of the page. And these names have benefited from this whole stay-at-home thematic due to COVID. Over the long run, we still remain positive on these internet company names because the long-term structural growth story remains intact. However, there will be near-term overhang on stock price, hence we have reduced our exposure to the space, as Mary has mentioned. So with that, I will pass it to Freddie.
Thanks, Eric. Another factor to consider for our portfolio heading into next year is the currency, and specifically the direction of the US dollar. A number of currency forecasters have the US dollar depreciating in 2021 due to improving risk sentiment and better global growth next year. Historically, a weaker US dollar has been supportive for emerging markets and Asian equity performance, but that relationship has decreased somewhat over the past few years due to three key reasons. Firstly, Asia is much more domestic demand focused and less export dependent than in the past. Secondly, the current account and fiscal positions for many Asian countries have improved significantly over the past few years. And finally, Asian capital markets are much more developed now and therefore less reliant on US dollar denominated debt. Having said that, though, there are a number of areas where a weaker US dollar will have an impact on our portfolio. Firstly, a weaker US dollar against the Indian rupee will be a headwind for earnings in sectors such as IT services and pharma. We currently hold a couple of Indian pharma companies in our portfolio, such as Sun Pharma and Dr. Reddy's. So the INR is something we'll be watching closely in the coming year. Secondly, a weaker US dollar against the Aussie dollar in isolation is a headwind for absolute returns for the portfolio. But that is typically offset by the fact that a stronger AUD is representative of risk-on sentiment and therefore good for asset prices in Asia. And finally, a weaker US dollar against the Aussie dollar is also typically associated with higher commodity prices such as oil and to a lesser extent iron ore. This, however, should only have a very small impact on our portfolio because, as Mary mentioned earlier, most commodity companies don't actually meet our strict ESG criteria and therefore are uninvestable for us. So if we turn over to slide 14, as most of you are aware, valuations technicals is something that we monitor very closely, and you've probably seen some of these charts in a few of the seminars previously. The key takeaway from this slide is the fact that heading into 2021, valuations and technicals are both looking very stretched. It's hard to believe that 8 months ago, we were comparing valuation multiples in every single financial market to the lows of the GFC. Fast forward to today, a number of countries such as the US, Japan, Australia, and India are trading close or at the highest levels since the GFC. Many countries are also overbought or close to being overbought. And when you combine this with the lofty valuation multiples and the elevated level of capital markets activity that we've seen recently, it's leading us to be a bit more cautious with regards to positioning as we head into 2021. And with that, I'll hand it back to Mary, who will talk a little bit more about the recent capital market activities that we've seen.
Great, thank you, Freddie. One other thing we wanted to talk about in terms of the outlook for 2021 is the capital market activity. So this is both something to be excited about and a bit of a red flag. So the part to be excited about is that in Asia, as we have mentioned before, Asia is home to some of the largest unicorns in the whole world. You can see on the chart on the right-hand side, you have Ant Group, which we can talk about later, ByteDance, Reliance Jio. You have many companies that have very large valuations, which are expected to list in the next 12 to 18 months. And the other good thing for our portfolio is that most of these companies that are listing are part of companies that we already own. And so we're expecting valuation uplifts and a real excitement about Asian capital markets going forward. The negative part is what's on the left-hand side. You've recently seen some very big IPOs, which is a positive. We have participated in JD Health recently. We did not participate in Nongfu or Lufax. But the number of capital raisings that are happening every day is getting a little bit alarming. So there was one night last week where between when Hong Kong market closed and about 3 hours later, there were 5 deals that were launched. And you can see just the stocks that are down there, they've raised $11 billion in the last 2 weeks. And actually NEO has raised since then. So that's, $12, $13 billion. Just in the last few weeks. So the fact, combined with what Freddie said earlier about valuations, that a lot of these stock prices have gone up immensely since the March lows. They are near all-time highs. The valuations are stretched, and so many companies are choosing this time to access capital markets is a bit of a signal. So we're not changing our portfolio certainly because of that, but we are cognizant of the fact that things are looking a little bit stretched. and I would expect our cash balance to go up over time rather than down. So that is the conclusion of the formal presentation slides. I think with that, we'll turn it over to Q&A.
Thanks, Mary. Thanks, team. We've got some fantastic questions that have come through. The first one is, any update on the Ant Financial IPO?
Yeah, so maybe I'll just give a sort of recap of what happened with that. I think the last time we did the webinar in October, there was a lot of excitement about Ant, and certainly we were excited about it. We did participate in the IPO and we got an allocation, and then as you will all know, it got canceled with 36 hours to go. So the reasons for the cancellation, there are multiple reasons there. First of all, I think the timing of trying to game it over the US election was, in hindsight, a mistake. The second thing is, as you probably all know, Jack Ma gave a speech where he called the Chinese banks pawn shops, which really put the regulators offside right before the IPO. And then thirdly, I think just the amount of wealth creation for Jack Ma and his friends, and excuse me, what that means in terms of his power position within China was not taken positively. So for those three reasons, it was potentially canceled. And the reason that they actually gave, though, was because of the new regulation regarding fintechs. So this is actually something that I think in all countries, not just China, people are going to have to think about, because Ant Financial is a fintech, and there are a lot of analysts who were banks analysts or financials analysts looking at it, who had one view of the regulatory risk, and then there were internet analysts looking at it who had a different view of regulatory risks. And I think the fact that they have come out and said there are certain parts of Ant's business that have, capital requirements and are much more financial than they are internet, suggests that these, regulation for fintech globally is going to be an interesting space, because are they banks or are they technology companies? The answer is a bit of both, and I think the regulation will have to reflect that. So we have gotten a question, I think, also about when Ant will come back online. Sometime in the next 12 to 24 months. My guess is closer to 24 than to 12, because some of these regulations are not easy things to fix, particularly the capital requirement aspect of it. And certainly when it does come back, it's not going to be as hot or as highly priced as it was before. So the cancellation of that was a detractor from our performance, because obviously we had a very big position in Alibaba going into that, as did a number of other people, because we did get an allocation in the IPO, but it was very, very, very hard to get an allocation. And so for people who couldn't get an allocation, they bought more Alibaba so that they would at least get an indirect benefit. And then when the whole thing unraveled, then all of those stocks went down. So that's one of the reasons why we have a smaller position in Alibaba right now, just to wait and see what happens both with the antitrust regulation and also with the future of Ant.
Thanks, Mary. All right, next question. Given what's transpired in 2020, can the team comment on thoughts around healthcare in Asia as an investment opportunity? In particular, could you discuss thoughts on Ping An Healthcare, JD Health, and other tech or internet-based healthcare business models?
Yeah, this is a great question, because if you go back to that pie chart in our presentation, we actually have more exposure to healthcare right now than we have had ever before in this portfolio. And part of those are like the pharma stocks that Vinay talked about before, and part of that is sort of the JD Health and those kind of stocks which are now available to invest in. So we did participate in the JD Health IPO. It's been a very strong performer. It IPO'd around $71, and it's already at $131, and that's 1 week's performance. So that has performed very strongly. We own Ping An Insurance, but we don't own Ping An Technology directly. I'll turn it over to Vinay to give our reasons for that. He covers those stocks.
Thanks, Mary. Yes, we are actively looking at various health tech businesses in Asia, and within these are preferences for businesses like Ali Health and JD Health, as their business models have a lot of optionalities built in. Both businesses operate in the rapidly growing online pharmacy market in China. Both of them are also making inroads into the telehealth space, which is currently dominated by Ping An. In our view, Ping An Health only has exposure to the telehealth space, which while it is an area which has received a big boost due to COVID, but the telehealth business, in our view, could see growth rates moderate as things normalize over 21 and 22. To sum it up, we prefer JD Health, which we own, as Mary said, as it offers multiple levers of growth, versus Ping An Health, which is currently heavily leveraged to the telehealth space.
Thanks, team. All right, next question that's come in. There are a number of prominent persons like Draghi and Rajan warning about potential for an insolvency crisis in 2021. Will this affect investments in financials?
Yeah, so this is another good question. There is an article on Bloomberg quoting both those gentlemen this morning. So I was worried, much more worried about that 9 months ago than I am now. So when COVID first hit, that was one of the reasons we were underweight financials. And so I continue to be the financials analyst on this team, and I went through all the banks and put in the worst NPL number I could think of. And while that sort of scenario would lead to sharply negative earnings growth, it actually doesn't lead to a solvency crisis in the banks in Asia. Now, that may be different for the US and Europe. I am not, working on active models, obviously, for those sorts of banks, but certainly in Asia, and certainly the banks that we own, even under a very, very extreme NPL crisis, it's not a solvency crisis. It's just an earnings, it's an earnings dip. So I am mindful of that. I think that, I guess the other thing I'll say is that a lot of banks in the second quarter this year were very worried about COVID, and they put in huge provisions. So, we did a model review last week where I was looking at one of the Philippines banks and some of the Singapore banks that we own, and there's actually a decent chance that they will be able to write back some of those provisions over the next 2 years because they over-provisioned too much in early 2020. And so the short answer to your question is maybe for US and Japanese and European banks, and Australian banks certainly, since JobKeeper and JobSeeker were so large, that's an issue, but I'm very comfortable in terms of the banks that we own, that solvency or insolvency is not going to be a problem.
Thanks, Mary. We've got a question from an offshore participant. We're in Malaysia and gaming is huge here. Are you playing this thematic?
Yeah, so thank you for the question. We actually have very strict ESG criteria, and gaming is one of the sectors that we screen out. There are certain reopening. I think the reason that it's huge there, there are multiple reasons for that, but a lot of the reasons that people are looking at gaming stocks right now is because it's seen as a reopening play. And as Vinay mentioned before, our preference is to look at vaccines and reopening plays at a direct level rather than an indirect level. And so we are not invested in any gaming stocks at this time.
Thanks, Mary. You noted the addition of more ASEAN exposures to the portfolio earlier in the presentation. What specific names have you added?
Yeah, so it's mostly financials. We have added Singapore banks. We own a bank in Indonesia. We own a bank in the Philippines. And those are relatively large positions. So the increase in ASEAN and the increase in financials are largely the same stocks. We have added one non-financial in Thailand, and I'll turn it over to Freddie, who will talk about IVL.
Yeah, so the name that we added in the portfolio in Thailand is a company called Indorama Ventures, ticker IVL. It's the Thai listed chemicals company. It's actually the world's leading integrated polyester producer. So it produces like the key inputs that go into like the PET plastic bottles that we use and the polyester fiber in our clothes and furniture. We brought this company on an earnings turnaround story on the back of a pickup in polyester prices driven by increased demand due to the global consumption recovery that we're seeing around the world. We think this upturn can persist for a few more months. The stock was trading on around 13 times forward PE, and we bought into it. And we think earnings could double off a low base in 2021. And the stock has actually done quite well for us, and is up 27% over the past month.
Thanks, team. Great questions continue to come through. ESG is now a core focus for the fund. Could you comment on the Chinese electric vehicle players and their valuations relative to Tesla? Is there a better relative value in green revolution stocks elsewhere in Asia?
Okay, excellent question. Thank you very much for this. This is a major thematic that we are focused on in the next 6 months. In fact, we have a summer intern, Alex Marinelli, who started today, and part of his job over the next few months is to help us get up to speed in terms of how, this is going to be a huge thing. And it's not just EVs. If you take a step back, it's probably a month ago now, China came out with a whole policy to be carbon neutral by 2060. And so working back from that, if China's going to be carbon neutral by 2060, they have to have peak emissions by 2030. And that's, 9 years away. And so for those of you that follow these EV stocks closely, at the same time, China came out with some new regulations in terms of the number of vehicles on the road by 2025 and 2030 that need to be EVs, or they call them like NEVs. In China, and it's quite dramatic. So at that time, you saw stocks like NIO and Xiaopeng and Li Auto absolutely take off. So we are focused on 3 parts of that sort of green technologies. One is the EVs themselves. One is the EV battery, the EV supply chain, which at this current time is largely batteries, and that's a sector that Freddie covers. And then the last one is other green technologies. So this is just part of the overall China Net Zero, 2060 program, whether it's wind or solar. Again, if you sort of back solve the math from peak emissions in 2030, they're going to have to make massive investments in these other, alternative energies sources in order to meet those criteria. So in terms of the EVs in general, we do have a small position in NIO right now. Relative valuations versus Tesla, I don't really want to comment on that because there are different times in their company evolution. So, Tesla lost money for a long time and NIO is still in that stage. So it's difficult to compare because they're at valuation-wise because they're at different stages of development. Interestingly, you have seen all of these companies raise money in financial markets in the last 2 weeks. So that's telling you something about what they think of their own stock prices. But as an overall thematic, I think this is going to be a major thing in Asia, certainly over the next year and possibly even the next 5 to 10 years. So it's something that we're very focused on. We do own Samsung SDI, which is our way of accessing batteries. So those are the two ways, NIO and Samsung SDI, are our exposure to EVs at this current time.
Thanks, Dean. Next question. Given the experience this year with Tencent and Alibaba, is it fair to assume you will not put more than 10% of the portfolio into any one stock going forward? Do you have a target or max total weight for your top 10 holding?
All right, thank you for the question. No, we don't. I mean, we're a concentrated fund. We can only have 20 to 50 stocks. And if you really are concentrated, then, you should, this is not a hard rule, but we generally would like to have more than 50% in our top 10 holdings. With respect to Tencent and Alibaba, we've actually had over time a fantastic experience with these stocks. And it's a point I really, really want to make for our investors and for investors in global funds in Australia who have very recently invested in Tencent and Alibaba. So, my entry price as an investor in Alibaba was $68. That was the IPO price. And this fund hadn't started yet, but, the fund within Ellerston that I was working for, we invested in Alibaba at IPO price was just $68. Our entry price for this fund is about $80. Our entry price for Tencent is $130. So, for us, like that is an amazing to invest at $80. And we sold some Alibaba above 300. And obviously now we sold a little bit more at 275. And now it's at 256. But, that is an amazing investment case. Tencent, the same thing. We invested at 130. We've held it for many, many years. We sold some at 600 and, we still have a decent position at 571. And so I think we've had a great experience with these companies. And we do think even though there's some near-term concern with respect to the antitrust, I don't think that, this is certainly not a reason not to own these stocks. It's a reason to have slightly smaller positions. But, we've seen this before with Tencent and the regulation with respect to games, Alibaba and the regulation with respect to, counterfeit goods and stuff like this. They go through cycles, but over the long term, these are very, very good stocks to own. So, when we feel more comfortable with them, I'm comfortable having position sizes back up over 10%.
Thanks, Mary. I might give participants a chance to pop any further questions through. We do have one final one, and apologies if the screen has gone blank. We're just working on some technical issues here. Team, tech remains a very large part of the portfolio. Given how well tech has performed this year, what are your views on the sector heading into 2021?
Yeah, I'll just say one thing and then I'll turn it over to Freddie, who's the tech analyst. If you look at our top 10 holdings, we actually look at the stat companies, so that's Samsung, Tencent, Alibaba, and TSMC as sort of a mini portfolio, and we make sure that those position sizes are always, we think very hard about those position sizes relative to each other. So, for a long time, Alibaba was by far the largest position, then followed by the other three. And now we do have a preference for Samsung and TSMC over Alibaba and Tencent, which is reflected in the top 10. So that's my overall view, but I'll hand it over to Freddie to talk about technology in general.
Thanks, Mary. Yeah, so the tech space, the reason why it's done well this year is a lot of the names that we held were beneficiaries of the lockdowns and the work from home that happened during COVID. But as Mary mentioned during the presentation, that thematic has largely played out and the outlook has shifted towards the reopening of economies. And we think that thematic will remain the focus for investors as we enter 2021. So we are currently overweight only the cheaper tech hardware names such as Samsung and SK Hynix. But we still hold the domestic demand tech names such as like Tencent, Alibaba, Meituan, and JD. But as Mary mentioned earlier, we have taken profits on these names in recent weeks, and we're largely equal weight.
Okay, great. Thank you, Freddie. I think those are all the questions that have come through. So I'll just wrap up. Thank you very much, everyone, for dialing in and for your support over the last year. We are very excited going into 2021. We think now is a great time to be investing in Asia. There's a lot of attractive stocks, a lot of new stocks coming online. And as I mentioned before, we think Asia is going to perform much better than developed markets over the next 12 months. So with that, I'll turn it back over to Lisa, and we look forward to touching base with you next time.
Thanks, Mary. Thanks, team. Well, we trust you all enjoyed our monthly updates this year. For 2021, we're going to shift to quarterly updates with our first webinar due for March. We will send details through of that date once set, but if you have any questions in the meantime, please do send them through to info@ellerstoncapital.com. Finally, a recording of today's session will be sent through to all participants shortly. However, if there's anything further needed, please don't hesitate to contact a member of the Ellerston distribution team, as we're more than happy to help with any matters as required. Thank you all for attending, and I trust you have a good rest of your day.